All right, welcome to the second Student Loans Update mini webinar. This is the second in our mini webinar series specifically on federal student loans as we are re-entering repayment. My name is Andrea Pellegrini, and I run the University of Illinois System Student Money Management Center for Urbana, Chicago, and Springfield. And I'm joined today by my colleague, Nikki. Do you want to introduce yourself, Nikki?
Of course. So I am Nikki Jankola-Shanks. I am the policy director within the Division of Banking at IDFPR.
Thank you, Nikki. So we're going to launch a poll, and we just want to get an idea of who's joining us today. We can emphasize things a little bit differently based on some of the demographics. We also are joined in the chat by our colleagues in Illinois Extension who rely on demographic information to maintain their funding to do statewide consumer education like what we're doing today. So that will really help out our partners if you can kind of answer those questions that we have about demographics. We're not going to be sharing individual responses, so don't worry about that, but it gives us a broader idea of how diverse our audience is and what kind of your needs are. So it looks like we have people in several age demographics, both full-time employees and current students and retirees. And fabulous. We have about 70% of people that participated, but I'm going to leave it open for about 5 more seconds before I close it because, again, we have a lot to cover today. All right. And I'm going to go ahead and end the poll. This is what it looks like. I'll share that real quick. You can take a look, and I will stop sharing. All right. So our objectives today is to discuss, again, you want to know who your loan servicers are. We discussed that during the first update. We're going to emphasize repayment plans and talk about strategies. And we're going to discuss some tools that exist to help you understand what repayment plan options might work best for you. And as we did last time, this information that we're sharing today about federal student loans is rapidly changing. So what is discussed in this webinar is current as of August 18th, 2023 at noon Central Time. So there could be new information that comes out after this, but this is what we have today. And we're going to share general information, but we cannot provide financial advice on specific situations. And you want to be careful about what you share in the chat so other people can't take advantage of that information. So just be very careful. All right, I'm going to hand it over to Nikki to talk about repayment plans in general.
All right. So as Andrea said, this is our second webinar. Each webinar, right, we're going to focus on an aspect of student loans. Today is repayment plans. So this kind of is a visual just to see there are currently 8 repayment plans that somebody can pick from. 5 of them are income-driven repayment plans, and 3 of them are not. Andrea, thanks. So finding the right repayment strategy, you're going to hear some information and think about priorities that you personally have when you sit down. So things that you'll need is what your job is or other income, anywhere where you get income from, what's your income for the year, your family size, do you have health insurance, things like that. Then you have, you need to make sure you have all your loan information too. If you have federal loans, which servicer do you have? If you have institutional loans, private loans, as well, like which loans are federal versus which ones are private will help as well. But especially what you need to think about is, given all of that personal information, what is your actual repayment goal? And this is something that could change over time. But when you first sit down, like, do you want to pay off your loan as fast as possible? Do you need a low monthly payment? Do you want to pay the lowest total over time? And Is your career something that you could use public service loan forgiveness for? We are going to have an entire separate mini webinar on just the public service loan forgiveness program. So we'll mention it today, but just know that is coming as well. All right, so this is just excuse me, summary. We are going to talk about each of these, but as Andrea said, you will be getting the slides to this webinar. I know we had like over 100 people sign up, so we will have that. People can read it, but I'm also going to talk about it. And if you need to rewatch, just know this is kind of like a quick summary of some of the highlights of the repayment plans. All right, so this kind of shows you the difference between a standard repayment plan and a graduated repayment plan. For if you, let's say you have 30,000 in student loan debt, all right, that black line represents your standard repayment plan. You could see it basically stays exactly the same in order to pay it off within 10 years. The green line is a graduated plan, and it starts off lower and then gets higher. And the thinking of that is that when you start off with your career, you may not be making as much money as you would towards the end of it. That is the major difference between there. One thing we definitely want to highlight is that if servicers just turn on your repayment option and you do not go in and select a different repayment, standard is going to be the default option. So if you don't select anything, that you will be automatically enrolled in this standard 10-year plan. All right, so now we're going to talk about the extended repayment plan. This is the last of the non-income driven plans. This is basically the same as the previous two, with the big difference being, in order to be eligible for this plan, you have to have more than $30,000 in outstanding direct loans. So if you have 12,000, you would not be able to use this repayment plan. This also, it can, if you have a Parent Plus loan, Parent Plus loans are not always eligible for certain types of repayment plans. So if you have a Parent Plus loan, they are eligible for the extended repayment plan. And basically what that means for extended repayment is the payments can be fixed or graduated, but you have, instead of 10 years, you're paid it off up to 25 years. And the monthly payments are lower, but you'll pay more over time. Sorry. All right, so now we are going to talk about income-driven repayment plans and what that means. Two things we want to highlight for all income-driven repayment plans. When any part of your loan is forgiven, you may have to pay income tax. There's a lot of factors that contribute to that, depending where you live, what state you're in. So just be aware that you may have to pay income tax. And it's important to note that the monthly payments on an income-driven repayment plan will never exceed the standard repayment plan. All right, so this is a lot of words on this that you're probably like, I have no idea what this means, but income-driven repayment plans are based on your discretionary income. This is how discretionary income is defined. So it's the difference between your adjusted gross income and 225% of the U.S. Department of Health and Human Services poverty guideline amount for your family size. But do not worry, you never have to calculate this. The discretionary income piece is done for you. So if that was a whole lot of jargon that you are confused about, don't worry. All right, so then we have the income-based repayment and the income contingent repayment plan. Both of these, you need to submit annual documentation documenting your income and family size. Your payments for both of them change as your income changes because it's right income driven. It's based on that income. Um, so, and after in income-based repayment, after 20 or 25 years, the whatever is unpaid will be discharged. In income contingent, it's always a 25-year repayment plan, and after 25 years, any unpaid portion is discharged. In the ICR, the income contingent is only for direct loans. That is the biggest difference we want to highlight. So if you are a parent and you have a Parent Plus loan, you could qualify this only if you consolidate it. Again, Andrew and I are going to talk about consolidation on a future webinar as well. The way that they calculate your payments changes a little bit between the two as well. But those are pretty much the highlights between those two. All right, so income sensitive repayment plan. This is called an ISR. This is the only option if you still hold federal family education loans known as FFEL or Stafford loans. Those two types of loans are no longer offered by the Department of Education. So this is, but people may still be paying on them from when they were giving them out. So if you want an income driven repayment plan, you would, and you have those one of those two loans or both, you would have to, ISR is the only option you have. Payments are still based on annual income. And this one must be paid in full in 15 years. So now we're going to talk about pay as you earn, known as pay. So again, you must be a new borrower on or after October 1st, 2007, and received a disbursement of a direct loan on or after October 1st. Pretty much all loans are eligible, except again, that does not include plus loans made to parents. So if you have a Parent Plus loan, you cannot use this payment plan. But if you have a plus loan for a student, then you can. If you're a student and you have a plus loan. The payments are calculated on 10% of that discretionary income. And they are recalculated each year based on when you update your income and if your family size changes. So it will never be more than that 10% of discretionary income. But again, you don't have to worry about calculating it. The biggest part about pay is that you have to have a very high debt to income ratio. So not every borrower is going to be eligible for this plan. This is aimed at people who may need, who have a very high debt, but may not be earning what they need to cover that debt yet. And this is eligible for public service loan forgiveness. All right, so you guys have probably heard this is what's been in the news a lot lately, which is why Andrew and I wanted to talk about it this month on this webinar. I just want to stress again what Andrea said in the beginning, that this is what we know as of today. All right, so saving on a valuable education loan, or I'm sorry, saving on a valuable education repayment plan known as SAVE. This is brand new. So nobody has paid on this yet in terms of like the terms of this repayment plan, brand new. If you were already rolled in what's known as Repay, you're going to automatically be moved to the SAVE plan. So Again, if you're already enrolled in repay, you're gonna be automatically moved. This increases the income exemption to 225% of the poverty line as defined by the US Department of Health and Human Services, which basically is saying more people are going to qualify for this. Again, direct loans are eligible, direct plus loans made to parents, any direct consolidation loans that do not include plus loans made to parents. So again, this is Parent Plus is not currently a part of this plan. Some of the highlights: 10% of your discretionary income, which is down. The repayments are recalculated each year, just like the other income-driven repayment plans. One big change is that if you are married, both you and your spouse's income or loan debt will be considered if you file jointly. If you choose to file separately, then it will not be considered. And then any outstanding balance will be forgiven if it's not repaid in 20 years for undergraduate or 25 years for graduate. And perhaps the biggest change with this plan is that if you make your monthly payment, your loan balance is never going to grow due to unpaid interest. So that's probably the between expanding some who can use this loan, I'm sorry, I keep saying loan, this repayment plan, and cutting down on your monthly payment, what part of discretionary income, and your loan balance won't grow due to unpaid interest, will hopefully lower payments for the majority of people. So this is kind of a graphic that talks about that interest piece. So if you have $50 in interest that accumulates each month, okay? And your payment though is $30, then that remaining 20 would not be added to your principal balance. That part will be wiped. So that's how it's not growing due to that unpaid interest. This is another plan, like a summary plan that we did. I'm not going to go through this because we just talked about the different repayment plans. But again, you guys are going to get this in your inbox, and you could rewatch this webinar. So you could pause and take a look in case it's easier for you to see it visually this way.
We also shared it in the chat. I believe Suhas shared the link to this PDF for the slides in the chat earlier. Suhas, if you want to share again so people can access this and take a longer look of it, that would be really helpful.
And then just a few notes on consolidation. Like I said, we are going to do a whole webinar on just consolidation, but just something to be aware of is that many of these repayment plans, as I just discussed, are only available for direct loans. But there are several exclusions for that direct consolidation loans that are used to pay off Parent Plus loans. If you have a Perkins loan, again, those are no longer currently given out anymore. But if you do, they have their own unique benefits. So you are going to want to review those before deciding to consolidate. A big thing that we get asked that we want to talk about is that consolidation of your loans is not the same as refinancing a loan. And we will get, again, more into that next month when we talk about direct consolidation loans. And now I'm going to turn it over to Andrea, who's actually going to walk us through the loan simulator on FSA.
Thank you so much, Nikki. So Suhas is going to drop in the chat the link to the federal student aid website where the loan simulator lives. And we're going to just go through a case study of using the loan simulator to help make decisions about repayment. So in our case study, there are some assumptions that we've made. I've highlighted them here, but you can select them as you go through the loan simulator. And we have highlighted several screenshots that we took earlier today, which the loan simulator is frequently updated, so it might look different later. And we didn't want to do a live demonstration in case the site went down. So we're just doing some screenshots to walk you through the general process. So the first thing after you log in and start using the loan simulator is you choose there's several options to choose from. In our case study, we are selecting I have a job or plan to get one soon, as well as I filed taxes in the last 2 years. The next section is about your tax filing status, which is why Nikki mentioned earlier that you would need information about your taxes in order to complete this or to think about what your repayment options are. And so this is where that tax information comes in handy. For our case study, we are selecting single. You'll want to select whatever you have indicated in filing your taxes, be it single, married, married filing jointly or separately, etc. You'll also need to identify what state you're living in or plan to live in. For instance, if you're moving away after graduation or in the next few months, since that's often part of the calculations for income-driven repayment options. So in our case, we are selecting Illinois because that's where we are. You'll also need to identify your salary. We used an estimate from University of Illinois Springfield's school data. So there's an option there to use my school's data if you are unsure or still looking for a job. And so this is what that tool looks like within the loan simulator. There's an estimate your income option. You can select what state, school name, your degree or certificate, as well as your field of study, and it will show median salary after graduation based on the college scorecard. And so you can use that, or you can use whatever is in your offer letter if you just got a job, or what you normally are making throughout the year. There's also an option for annual income growth, because that is very helpful for kind of deciding what your payments look like over time. The default is 5%, but we put ours at 3% for this case study because our student is planning to pursue state employment, which tends to have lower income growth than corporate environments. So that's something to consider as well. We also estimated the loan balance using our University of Illinois Springfield data for the same degree program, bachelor's degree in communications and media study. So if you choose to estimate rather than using your own, which, just to emphasize, it's best to log into the FSA website and use the data that's already in your FSA account. But if you are just starting out your degree program, or you're trying to get a better idea of different loan options that you might be borrowing for, you can use national loan data or data specific to a school. But it's best to use what data already exists in the FSA website for you. So again, this is our assumptions. Based on our bachelor's degree in communications and media study, our average loan balance for UIS is $16,635, and the average interest rate is 3.9%. Interest rates vary depending on when your student loan was dispersed, so it could be more or less depending on what it was at the time of disbursement for your loans. There's also an option for you to choose whether or not you are trying to pursue public service loan forgiveness, which again, we will talk about more in depth at a later webinar. But for this case study, we're going to say yes, at least initially, just to see what our options are. There's also an option to choose what your primary repayment goal is. Something that Nikki mentioned earlier was to think about what your primary repayment goal is. There is an option to say, I don't have a specific goal, and so that's what we're going to do here. But if you want to pay off your loans as fast as possible, you can select that, and it should prioritize that in the result that it gives you. So in our case study, based on all the information that we provided, the loan simulator estimates that our payments are going to be between $10 and $32 per month until July of 2033. If we enrolled now in the plan that they suggest and are already working full-time for an eligible public service loan forgiveness employer, which again, we're going to talk about public service loan forgiveness later because it's its own beast, right? These are all complicated aspects of student loan repayment. So the SAVE plan is what would give us that low monthly payment of $10 to $32. And we would pay a total of $2,392 over a 10-year period. And the amount that would be forgiven at the end of that 10-year period would be $16,635. Now, let's say that our case study borrower wasn't able to find a state employment job. And so assuming that the salary is similar, the income growth is similar, but they're in a different field that's not eligible for public service loan forgiveness, we did look at that with the exact same information, and the monthly payment would be between $10 and $69 every month. The total that would be paid over a 20-year period instead of a 10-year period would be $8,468. And then the forgiveness amount would be $16,229. So that shows you a difference on with both scenarios, whether you're choosing public service loan forgiveness or you're not eligible for it. SAVE was best in this case study. If our debt amount changed, or if our income changed, this might not be the best plan. So it's important to use the loan simulator yourself to determine what is the best plan for you. As we mentioned earlier, the loan simulator is going through a lot of changes. The SAVE plan itself wasn't added until like the last couple weeks. We tested it early last week and it wasn't there, and then we tested it this week and it was there. So it's important to know that there are some kinks that are being worked out as they're updating some of the loan simulator. For example, when we did a comparison between SAVE, the standard plan, the graduated plan, in the Your Information section, it showed that our loan debt was $0 when it was actually $16,000. And our interest rate was $0, but it's actually 3.9%. But these graphs show you the difference on total amount paid over the repayment period. So for all three of these, this is a 10-year plan, and we're using public service loan forgiveness with the SAVE plan. So just keep that in mind. This is a tool that can help you think through how to pursue your repayment strategy. But again, it's an estimate and they're still working a few things out with the tool, but it is good to at least give you a starting point to think about how to make decisions over the next couple months. So I know that we are running a little bit longer this particular webinar compared to our commitment of 20 minutes, but some action items to think about is to make sure that you set up an account with your loan servicer or servicers if you have multiple. If you haven't already done that, you want to use the loan simulator to figure out which plans you might qualify for. And then you want to make sure to contact your contact information in the federal student aid account and with your loan servicers matches what's listed on your IRS form 1040 to make any certification easier if you choose an income-driven repayment plan, because certification is going to be required every year, and they're going to be looking at the IRS form 1040 to confirm that information and make it a little bit easier. Excuse me. All right, so you can stay in contact with us, and we will also be staying on a little bit longer for any questions that you might have, but please feel free to log off if you want to. Um, and if you have any questions later that you think of, you can email studentmoney@uillinois.edu.
And again, we know that was a ton of information in a short amount of time, but we wanted to kind of go through what the different options currently are and let you think about what may be best for you.
Someone asked, how do you sign up for future webinars? It's the same URL to register for this one. So if you don't remember signing up for this one and somehow it was forwarded to you, this is how you sign up. All right. We also got another question for discretionary income. Is there an option to attach other forms of debt like rent or mortgage to use for reducing payment size? No, they use discretionary. They're very specific on how discretionary income is defined. And so they use the poverty line information for income. And so you might think about other options. For example, there's some options that don't use discretionary income for repayment. They use annual income or adjusted gross income and family size, but not how discretionary income is specifically described. So you might think about that. There's also, for example, with the save option, there are future changes planning to be made to that in 2024. And so revisiting your repayment strategy might be helpful for you longer term, especially as income can be variable for some people. Do you have anything to add to that one, Nikki?
No, I think that is great. You did a great job.
Thank you. Thank you. We have another question. If we have a Direct Plus loan and need to consolidate for the new plan, do we need, do we do that through MOHELA, and is there a cost involved? So the Direct Plus loan, you do have to apply for, and with all these income-driven repayment plans that we talked about, I think we kind of skimmed over the fact you do have to apply for them to see if you're eligible. It's not like a switch you pull in your servicer portal or on FSA's website. So there is a little bit of a lag time for implementing it. So if your servicer is MOHELA for your loans already, you can apply for changes there to your servicer. But if you're trying to consolidate, you get a new loan, a direct consolidation loan that pays off your Direct Plus loan and any other loans that you might have through the federal government. And the cost is in, what word am I trying to use? It's loaded into the front of the loan. So all federal loans have a service fee, basically. I think it's like, is it 1.8 or 2% of the total balance of the loan that they charge you at the beginning of your loan? It's added. And so there's a similar service fee charged to the beginning of your direct consolidation loan. There's another name for it, Nikki. What am I thinking of?
A direct consolidation loan?
No, the fee that's loaded in the front of the loan, not interest. It's the disbursement fee. It's called something else. I'm blanking on it. We do this so much, and I shouldn't blank on it.
I think the problem is lately we've been doing it so much that both of our brains are a little fried. But also, to answer Jody's question, do you do that through MOHELA? It really depends on who your servicer is. So you're going to do that through whichever servicer you have. There were a lot of servicer loan switches. So if you currently have MOHELA, that would be who you do that through. If you have one of the other federal loan servicers, then you do it through that.
And the FSA website has a start applying for direct consolidation loan on their website. So it's not just through servicers. Sorry, I'm trying to look up the consolidation loan fee question.
Both of our, we apologize. Is there any other question? Oh, thank you. Is that an
Origination fee,
origination
yes.
fee? Yeah,
You answered your own question.
thank
Yes, it's an
you.
origination fee.
Yes.
All right.
But again, that's something that is kind of built into your, like it's on the front end, like Andrea was saying. It won't be like a separate bill that you get.
Correct. Correct.
It's just incorporated into your repayment.
And that's also something to look out for. So there are some companies that are saying, we can lower your payments, we can consolidate your loans, and they'll charge you an upfront fee of $25 or $50 for the application, except all they're doing is taking all your personal information and then filling out the forms for you. So you want to avoid those people because there is no application fee. There's an origination fee once you're approved for the loan. All right, I got another question, another spicy question for Nikki and I. Are there any new updates about debt forgiveness after last court rulings? Do you want to address this first?
I will. So no is the short answer. Likely the way that they are going to go about any sort of debt cancellation, not forgiveness, but just debt cancellation is going to be that's why they're making tweaks to the income driven repayment plan through SAVE. They're hoping that that will make allow more people to qualify quicker. But as far as any sort of blanket cancellation, I know anything can happen, but I do not see that in the future due to the court ruling. But what the Biden administration has done is like that SAVE plan, they're making adjustments. They also, if you are a borrower who has been paying on their loans a long time, they've also done some back work on the back end to make maybe some payments count towards an income driven repayment plan that didn't previously. They also expanded the public service loan forgiveness program about who qualifies for that program. So while there's not any widespread cancellation of student loans, there's these other little programs and adjustments they're trying to make given the Supreme Court ruling.
Thank you, Nikki. That's a much clearer answer or more robust answer than I think I would have. I think I would have ended with no, unfortunately. And again, things are changing all the time. So there might be an article once you log off of this webinar that changes what we just, but hopefully not.
Hopefully not that soon. But what I would say is the bottom line is the loan simulator is a great place to start. Luckily, you still have some time before repayments begin, so you could play around with it a few times and make sure you're getting all your information right and how you want it beforehand. And then as far as the future of our webinars go, I know we mentioned we're going to talk about direct consolidation loans. We're going to talk about public service loan forgiveness. I would also say if you'll have our contact information if there's any particular questions or topics that you would like to see us cover. We'd also be open to that.
Absolutely. And we've left kind of our marketing around this student loan webinar series rather vague in case there are new things that pop up where we need to reimagine what we're talking about and what time we're talking about it. For instance, we had not planned to talk about repayment plans, I think, until next month, but then the SAVE plan, a lot of information has come out about. So we changed our whole strategy in order to better accommodate the kinds of questions around SAVE and repayment.
And in future webinars, if there's any additional information released about SAVE, we'll make sure to try to highlight that as well.
Absolutely. So again, if you need to leave, that's completely okay. If you have questions, feel free to ask in the chat. And there's also a Q&A feature if you want to use that instead. So we'll stay on for a few more minutes if you have questions, but don't feel obligated to stay on if you have things to do. We're recording the rest of this, so we'll make sure that that's sent out once everything is wrapped up today. Thank you for joining us.
Thanks, everybody. We hope it was helpful.
And we'll also be captioning this, so it might not be this afternoon that we send out the recording to all the registrants, but it could be next week sometime. We want to make sure that this is accessible to everyone. All right. Thank you so much for joining us. Have a great weekend and good luck in your return to repayment.